Right now, the US is imposing economic sanctions on various countries, which is essentially a form of economic warfare. These sanctions have profound implications, particularly for the US dollar. You see, the global financial system is deeply interconnected with the dollar. This is what we call the dollar system. But what's happening now is that countries are seeking ways to operate outside of this system. For example, India is now dealing directly with Russia, bypassing the US dollar altogether. This is a major shift because when the holders of dollar-denominated assets feel that these assets could be seized or frozen, they no longer want to hold them. This shift we are witnessing has happened before. In fact, history often repeats itself. Let me take you back to 1971 when President Nixon made a monumental announcement. He essentially said the US would no longer redeem dollars for gold, effectively ending the gold standard. This led to a devaluation of the dollar, which took many by surprise. I remember thinking the stock market would crash, but it shot up instead. Why? Because I hadn't yet understood the mechanics of currency devaluation. A similar event occurred in 1933 when President Roosevelt made the same decision, to abandon the gold standard, and the result was almost identical. This was a huge lesson for me. Studying history is crucial if you want to understand the present. This knowledge allowed me to anticipate the 2008 financial crisis because I could see the patterns from past economic downturns, like the Great Depression. The past offers a valuable guide to what's happening right now, especially as we approach a period of global instability. Today we are seeing a challenge to the established world order. Whenever one great power challenges another, the likelihood of conflict increases. History shows us that these challenges often lead to war. Now, there are different types of wars we need to be aware of. Trade wars, technology wars, geopolitical influence wars, capital wars, which we are already in, and of course, military wars. These conflicts drive countries to become more self-sufficient, reducing globalization and increasing nationalism. This means that countries are focusing more on their own needs and less on collaborating with others, which disrupts the global system. What does this mean for financial markets? Well, during times of war or conflict, the stock market often behaves unpredictably. It's not always about whether the market goes up or down. It's more about how the underlying value of money changes. When governments run large deficits, they need to spend a lot of money on things like social programs, defense, and environmental initiatives. If they spend more than they earn, they have to print more money to cover the difference. This excess printing devalues the currency, leading to inflation. This brings us back to the 1970s, a decade marked by high inflation following Nixon's decision to end the gold standard. The stock market may rise, but it doesn't necessarily mean wealth is being created. In fact, cash becomes less valuable, what I like to call cash is trash. Bonds, too, often produce negative returns in these scenarios. People start to realize that holding on to cash or bonds isn't a good strategy because the real value of these assets is eroding. So what do? They move their money into other assets, driving up inflation even more. Today, we're entering an environment similar to that of the 1970s. Governments face two choices when dealing with debt. Either pay it back with hard money, which leads to a depression, or pay it back with soft money, which means printing more currency and devaluing it. Throughout history, countries have always opted for the latter. It's a painful decision, but it avoids immediate economic collapse. We saw this in 1971, and we saw it in 1933. This brings up an important question. How should we think about the value of money? If a significant portion of your wealth is tied up in debt instruments like bonds, is that really a good investment? Bonds are increasingly becoming bad assets because their returns are often negative. This is why people are now asking if the dollar will maintain its status as the world's reserve currency. There are many alternatives emerging. Cryptocurrencies, for example, are gaining popularity. We're also seeing countries like China push their own digital currencies like the digital yuan. Gold has always been a traditional store of value, and it's becoming more attractive again. So, we are entering a period where different types of money will compete with each other. This shift is crucial because it signals a change in the global financial system. Now let's talk about debt. Every currency is essentially a form of debt. When you hold currency, you're holding a promise of repayment. But what happens when that promise loses its value? We are moving into an environment where currencies, including the US dollar, are going to decline in value relative to other assets. Will the dollar decline more than other currencies? That remains to be seen, but it's almost certain that we are in the midst of a shift. We're already seeing this play out. China's yuan is being used more frequently in international transactions. India and Russia are conducting trade directly, bypassing the dollar. This is a major change in the way currencies function as a store of wealth. A currency needs to be both a medium of exchange and a reliable store of value. Right now, the dollar is facing challenges in both areas. Inflation is another key issue. When the cost of borrowing money is lower than the rate of inflation, it encourages people to borrow and spend more. This creates a cycle where money loses its value even faster, driving up inflation. We've seen this happen time and time again throughout history, and it's happening now. The cost of borrowing is low while inflation is high, which is a recipe for economic instability. We are beginning to witness a paradigm shift. A paradigm shift occurs when the dominant way of thinking changes. For the last 40 years, we've been in a period of low inflation and low interest rates. It was perfectly fine to hold bonds or cash because inflation wasn't a significant concern. But now, that's changing. As inflation rises, people will begin to shift their behavior. They'll sell off bonds, which will further drive up inflation, creating a self-reinforcing cycle. This is exactly what happened in the 1970s, and it's happening again. When people start selling bonds, it forces interest rates to rise. Higher interest rates make borrowing more expensive, which slows down the economy. At the same time, wages may start to increase as workers demand more pay to keep up with rising prices. This creates a vicious cycle of inflation. On top of all this, we are dealing with global conflicts that are disrupting supply chains and making countries more inward-looking. Each country is trying to become more self-sufficient, which reduces the efficiency of global trade. This, too, is self-reinforcing. As countries focus more on their own needs, global cooperation diminishes, making it harder to solve international problems like inflation or economic instability. So, what does all this mean for the average investor? Well, when bond yields rise, it makes other assets like tech stocks less attractive. Long-term assets, in particular, become less appealing because the returns are lower compared to the rising cost of money. This creates a squeeze on the market. But even though bond yields are rising, they are still below the rate of inflation, which means you're losing money by holding them. Inflation is eating away at the real value of these assets. The Federal Reserve is in a tough spot. If they raise interest rates too much to combat inflation, they risk slowing down the economy and hurting the markets. On the other hand, if they don't raise rates enough, inflation will continue to rise. It's a delicate balancing act, and there's no easy solution. We are likely heading into a period of stagflation, where inflation remains high, but economic growth slows down. This is one of the most difficult economic environments to navigate. What can be done? Ideally, you want to reduce spending and cut back on debt, but that's easier said than done. Governments are caught between a rock and a hard place. They need to spend to support social programs, defense, and other initiatives, but doing so only adds to the debt. It's a difficult trade-off, and it's one that often leads to stagflation. In a stagflationary environment, traditional assets like bonds and stocks may not provide the returns investors are looking for. This is why it's essential to build a diversified portfolio that can weather these conditions. You need to think about alternative assets that will retain their value even as the dollar declines. Commodities, gold, and even cryptocurrencies might play a larger role in this new economic landscape. At the end of the day, every investment is an exchange of a lump sum for future cash flows. The key question is, what's the cost of that money, and what's the expected return? As inflation rises and interest rates fluctuate, these calculations become increasingly difficult. Stocks, bonds, and even cash all have to be evaluated in terms of their real returns, adjusted for inflation. Ultimately, we need to focus on productivity and the redistribution of opportunity. A strong economy requires a fair system where people can be productive and contribute. Without this, we risk deepening the wealth gap, which can lead to internal conflict. We've seen this play out in many countries throughout history, and the consequences are never good. The world order we are living in today was established after World War II. The United States emerged as the dominant power, controlling 80% of the world's gold and having the most powerful military. This gave the U.S. the ability to set the rules of the global financial system. But now, that world order is being challenged. Other countries are rising, and they're starting to question the dominance of the U.S. dollar. This brings us to the final point. We are moving into a new era of competition. Competition between currencies, nations, and economic systems. The rules are changing, and it's essential to understand how these changes will affect the global economy. As investors, we need to be prepared for a world where the dollar is no longer the undisputed global currency, and where inflation and debt shape the future of financial markets.